Is Roussel. All right, and we are recording. And so I am a senior banker at KeyBank based in Boston, and I'm also chair of FACC'Fin, the finance forum of FACC'Fin. FACC'Fin, the French-American Chamber of New England, is a private nonprofit organization that is dedicated to furthering business and networking for corporations, individuals between New England and France. The FACC'Fin network is a pretty big network. We have about 400 professionals in New England, 6,000 US and more than 30,000 members around the world. And in the Boston area, it's a wide range. It represents a wide range of industries across life sciences, digital health, software, technology, services, and other industries. FACC'Fin is the finance forum and has a dedicated purpose to connecting people working in finance, members of private equity, investment banks, advisors, bankers, corporate finance executives through a variety of events. On our webinar today, we have a few members of the finance forum, including in particular François Ducroux, who is going to be the moderator on our panel today. And I will point out that KeyBank is a sponsor to this event today. KeyBank is a large commercial bank with over 185 billion in assets across 15 states and across multiple industries, and provides a range of bank products as well as capital markets products. And we also have Natixis Investment Managers, who is a platinum member of FACC'Fin. With that, I will hand it over to François Ducroux, who is independent investment advisor, has been an advisor for 25 years in the Boston area, working with people across various investment considerations and more so with a global lifestyle. Go ahead, François.
Hi, and thank you very much, Louise, and thank you for your presence today, everyone. So excited by our presentation today. Today, we will be hopefully giving you very good information, which may be actionable for your situation, whether in your jobs or in your personal life. In no way what we're going to tell you tonight are recommendations, merely they are opinions from very smart people, which I think you're going to find very interesting. What we're going to do today is I'll have both speakers to give us a presentation of about 10 minutes. And really what we want here is to be more engaged with you, the audience. So we will have the rest of the hour dedicated to Q&As. So you have the possibility to submit your questions during the whole event, and I will sieve those and ask them to our guests. And so please go ahead and do that anytime. With that said, I have to bring this into context. And the context was, where were we 2 years ago? 2 years ago, it was March 2020, and Europe was in lockdown, COVID. We were just about ready to go into lockdown. The markets were in the midst of a 30% drop. And, after that, well, governments intervened. We knew that right when it happened, it was going to be big. So how did they do it? They brought excess liquidity into the markets and basically together organized a synchronized global recovery. What did that bring about, along with COVID, is effects on the supply chain and constraints there, which that brought into to the forefront issues of inflation. These inflation became so big, along with tight labor markets, that the Fed, has changed its tune. The Fed and other central banks are now striking a much more hawkish tone. And so basically, since late last year, we have a very, very different market. And not only that, but we have war in Europe, war in Ukraine, which is setting a whole new set of uncertainties in other markets, which are very important to us and are very hot. I'm talking about commodities and also currency markets. So we have a whole slew of material that is extremely salient, very important, and we're all paying attention, but it's very messy. So first, today, I'm gonna bring in someone who's gonna lay the landscape for us in a very, I think you're gonna really enjoy this. I'm gonna bring in George Matteo. George is CIO, Chief Investment Officer at KeyBank. I'll be very brief. What does he do? He basically helps to nurture assets in the billions, I think about $60 billion, and in giving his advice and what he thinks of the economy and where to go, dangers, opportunities, etc. So, George, I'm going to leave it at that and let you do the first part of our presentations today.
Super, great. Thanks, Francois. Appreciate the opportunity to be here and join everybody today. And thank you for that great introduction. I think you summarized my presentation very well. So if you'd like to cut to the end, I certainly can. But you summarized the current environment very succinctly and I think very appropriately. I'll still provide a little context though and try to fill in some of the blanks. First of all, though, sometimes people ask me when we do these conversations, what's on your bookshelf? So you can see behind me, there's a number of things that sit here. And I'm not going to read you all the titles, but I'll just kind of show you that there's a few things that are front and center when it comes to investments. I'll just give one quick commercial. The book on the left is written by a guy named Burton Malkiel and Charlie Ellis. I'm a huge fan of Charlie's, a big admirer of his, read anything he writes. But if you want a really great primer on getting started with investments, I can't recommend the book, The Elvis Invested enough. So quick little shout out there for Charlie. I also have a number of business strategy books on my shelf, ranging from Jim Collins' Good to Great. I would suspect that many of your participants have probably read something from Jim, or maybe something along the lines of Innovations from Clayton Christensen, two great seminal texts. But this is all kind of in context of things around current events today. And when I was thinking about kind of 2022, so looking back around Thanksgiving of last year, I kind of stumbled upon Tom Friedman's books, and he's become probably more important now, given the heightened geopolitical risk that you talked about, Francois. And he's a very thoughtful writer, and he's written a lot of great op-eds in just the past week or two that I would encourage people to take a look at. But one book he wrote some 20 years or so ago was called The World is Flat, and that set up a really interesting backdrop to how we think about geopolitics today. He also wrote a book called Hot, Flat, and Crowded, and that was kind of the inspiration for me to think about what 22 might look like, which is kind of why I'm leading to this conversation. So when we started thinking about the year, we talked about a couple things. We talked about hot inflation. So again, taking a page from Friedman's book. We talked about crowded markets, which I won't go into a whole lot of detail right now, but suffice to say, markets are somewhat crowded, and you have a concentration issue where it's not a bad thing to say this, but it is apparent to us that certain segments of the equity markets and also the bond markets have gotten crowded by some really large companies, which is, I think, kind of another source of volatility potentially. Thirdly, you have the very complicated geopolitical situation, which you explained very well, Francois, and that's all more apparent today. And so in our view, when you have these things up of hot inflation, crowded markets, complicated geopolitics, it suggests to us that things are going to be kind of choppy this year. And we didn't really quite envision this much of volatility, to be honest with you. We kind of think this would be a year of kind of flat-like returns, which is going to feel kind of crummy because we had so many great years in the past where markets were up and to the right. And the risk of a recession were rising, but we still don't think a recession is imminent. So again, risks are rising, but a recession is not at our doorstep just yet, hopefully. You mentioned, Francois, there are really some major sources of uncertainty right now. So just to succinctly mention those, we think of them as three. We talk about the pandemic. And frankly, we're all waiting, probably most of us are all waiting for somebody to call this an endemic, meaning essentially we can start getting back to our lives in some normal fashion, maybe treat COVID as we treat the flu. So this is more of I'm not a scientist per se, but I think this would be a case of feeling good about things and maybe seeing the economies around the world continue to reopen. Secondly, of course, is the risk around Powell or the Fed itself. They are behind the curve. As you talked about, Francois, inflation is here and they need to start acting appropriately. It's a very complicated outlook that they've got in their hands, even before the Ukraine situation, but that's just made it all more complicated. And then thirdly, of course, this is probably the biggest unknown, the third uncertainty, which is Putin. I just kind of label these all in threes to keep the alliteration intact of pandemic, Powell, and Putin. And I'll spend just a few minutes talking about each of these in the next couple, 3 or 4 minutes. So in terms of the pandemic, again, I think we could look at any number of charts. A lot of this information is available online. Great data exists to kind of document the fact that COVID is on the decline. It's not happening uniformly, and certainly we're not out of the woods entirely. There's a lot of things we just don't know. But nonetheless, COVID and the pandemic seems to be receding, and we're certainly hopeful that this continues to move into the rearview mirror as we go through 2022. Secondly, I talked about Powell's another source of uncertainty and the fact that they're behind the curve. If you look at this chart, and I apologize, it's a bit small and a bit busy, but this shows you essentially 2 of the Fed's forecasts. The chart on the right shows you their forecast for interest rates as they see it. The chart on the left is perhaps more notable, and essentially this is their forecast for inflation. When they think about inflation, they look at something called the PCE, the Personal Consumption Expenditures Index, kind of a mouthful. But what they talk about here is essentially their outlook for inflation for this year and also for next year. They will update their forecast next week. So this will be an important indicator to watch. But what I think is really noteworthy is the fact that if you look at where the Fed was in December of 2020, it wasn't too long ago, so maybe a year, 18 months or so ago, they thought inflation would hover around 1.8%, something less than 2%. In fact, they were actually getting frustrated, Francois, that people weren't actually seeing more pricing pressure. They were actually wanting inflation to happen. Well, guess what? We got it. And so in September of last year, so roughly 6 months ago, they raised their forecast from 1.8% to 4.4%. And then they came back again just 3 months later and said, we're still behind. We have to raise our inflation forecast again to almost 5.5%. We're going to get some numbers tomorrow that suggest that I think inflation will probably start with a 7, maybe even start with an 8. So again, in the course of about 18 months or so, inflation expectations have risen from roughly 200 basis points to 800 basis points. That's a significant jump, and it's something really bears watching. So again, for that reason alone, the Fed, as we say, is behind the curve and needs to adjust policy appropriately. Thirdly, I'll spend just a minute talking about the situation in Ukraine. Again, I'm not a geopoliticalist, but I think that geopolitical analyst, but I do think this is something that is really significant, a very significant development for sure. There's a lot of ways we can calibrate what's going on right now, but suffice to say, I think the relationship between Russia and Ukraine is very nuanced. It spans centuries. It's a very complex relationship. I would suspect that people on this call might know more about this than I do, but what is at stake is really nothing short of a really big battle, an ideological battle between democracy and autocracy. So in our view, I think this is probably one of the biggest sea changes of developments in the last 60, 70 years or so. And investors and really business owners have to pay attention to this in a very big way. So let me back up for a second in terms of how we got here with respect to inflation. So this is just one very simple chart that shows you essentially how much money was injected into the economy, not in dollars per se, Francois, but in terms of the percent of the overall economies themselves. So what we show you essentially here is the United States, the Eurozone, Japan, the United Kingdom have all drastically inflated their balance sheets to really provide stimulus to the people, the stimulus to businesses, and other government agencies as well. So this is just unprecedented. And if you look back further in time in terms of the Great Financial Crisis, we are multiples above that. So the Great Financial Crisis of 2008-9, the central banks had to take similar measures, but they've actually quadrupled that, essentially what they did this time with respect to COVID. So a significant amount of money that's coming to the economy. The result of that is that people have excess time. They also have excess capital in hand. They've been spending pretty aggressively. This is just looking at the overall US retail sales numbers. And essentially I drew a straight line to kind of show you where the trend was. And I also kind of noted essentially where the real estate bubble was, which was also somewhat of a consumer-led boom. And we got above trend there too, and then we had to adjust for that. Well, now we're multiples again above that. So again, we've seen this significant rise in spending. At the same time, as you mentioned, Francois, the labor market has been contracting. This is one of my favorite indicators. This is what I call take my job and shove it. So effectively, those people that have enough confidence to walk into their boss's office and quit their jobs voluntarily, leave the labor market, that is actually a major sign of confidence in the labor market. The fact that this is at a record high also suggests that supply for the labor market is down quite considerably. So demand is up, supply is down. What does that mean? As you said, Francois, it means inflation. So in our view, the Fed is likely to raise interest rates starting next week. The market right now is pricing in roughly 4 to 5 times additional rate hikes this year. This is, again, a pretty significant shift just in the last month or so, but despite the fact that Ukraine has actually created a bit more uncertainty, interest rates are still likely to raise in the near term. There are some concerns we have to be concerned about. One thing that people often look at when they think about where the business cycle is and try to determine whether or not a recession is imminent is that they look at the difference between short-term and long-term interest rates. So on this chart, on the top part, I show you essentially that very thing. The short-term rates are in red, the long-term rates are in blue. Short-term rates have come up considerably as people begin to anticipate that the Fed might be raising rates this year. So if I take the difference between those two rates, it's known as the yield curve. And typically when those two lines converge, a recession usually is imminent, maybe 12 months later or so. So for that reason, people are starting to get a bit nervous that maybe the Fed might actually have to correct too much and cause a recession to ensue. Again, we don't see that happening just yet, but that is a risk in the outlook that we have to be mindful of. I'll say just one more thing about quickly Ukraine and then turn it over to Jack. This is not in the deck, but I just thought it was important to note that as I see this, again, this is a really significant moment in time. And of course, it's a terrible humanitarian tragedy that we all need to be mindful of. But at the same time, it's changing policy around the world. What's happening in Germany and Switzerland and other parts of Europe is nothing short of amazing. So for that reason, I think we have to be mindful of that over the long period of time. And if I think about a little bit about kind of what that might mean for stock prices, one thing that we've talked about, maybe that the notion of a peace dividend might be coming to an end. This chart shows you essentially the average multiple of the S&P 500 over many, many decades. And really for the last 30 years or so, we've actually seen elevated price earnings multiples, meaning elevated valuations on stock prices, somewhat attributed to the fact that geopolitics has been somewhat of a sideshow. It hasn't been that much of a forefront investment consideration. If you look back at earlier time, however, where maybe the world was a bit more unstable, multiples were on average lower. So we're not making the case just yet that we have to factor this into our equation, but we should be thinking about this. So as we think about things going forward, one last point, and then I will turn it over to Jack, is that investors, I think, need to be very selective, and they also should be picking their entry points carefully. One way we can suss out just general sentiment and overall volatility in the market is looking at something called the VIX, the volatility index. And typically when it breaches certain thresholds, the forward returns are usually pretty good. It doesn't always mean this is not an automatic strategy necessarily, but usually when the volatility really ratchets it higher, and you can see over points of time, so the great financial crisis is really in the middle of your screen there around 2008-9, right around here. And then more recently, of course, COVID introduced another level of uncertainty and the VIX spiked again. So again, for investors that have some capital to deploy, we think it's time to be selective and be thinking about entry points, but also be vigilant on monitoring long-term risks as well. So with that, let me turn it over to Jack and look forward to answering your questions later on in the presentation.
Thank you, George. Thank you very much. I hope everybody was paying attention because that was so much information. All really, really good. I mean, this is my business, so I see this every day. Everything that you said was a nugget. So I'm sure there's going to be. We'll probably have to go back to some of these slides.
Sure, of course.
That being said, I'd like to introduce our next speaker, Jack Janasiewicz, who is a portfolio manager, an elite portfolio strategist at Natixis Investment Managers. His job is to take the work that the CIOs like you and the people like you, George, and to take that information and see how that impacts portfolio construction and asset allocation. And he's been doing this for quite a long time. Jack, I'm so happy to welcome you and to let you speak and tell us a little bit more about what to make of all of this, really.
Well, thanks again for the invitation to speak here, and Francois, I appreciate the the description of my backdrop. You laid the table out pretty well. I think George actually gave us a nice macro backdrop in terms of how I'm thinking about the marketplace. I think basically everything that George outlined fits nicely into sort of the portfolio portion of what I want to talk about. How do we maybe implement some of these ideas into a typical portfolio and how we're thinking about things. The first one I want to talk about here, it's something that I think has been expected for much of the first part of this year, what the market's really been dealing with, and it's that sort of shift in monetary policy where we're starting to talk about the potential for rate hikes, the withdrawal of liquidity by central banks. And as a result, what have we seen thus far? It's basically been a multiple re-rating, if you will. And what we're trying to show you here is simply the change in PE multiples since the start of the year. So you can see those red diamonds, if you will. Those are the multiples at the beginning of the year. And the bars show the drawdown that we've seen or the change in those multiples basically up to the last couple of days. And the thing to point out here is simply the multiples that are at the higher end of the range, relatively speaking, for the U.S. sectors, if you will, have seen the most or the biggest derating. And that's a function, I think, of the market turning and looking at sort of the potential for liquidity withdrawal and starting to reassess that backdrop. What's changed, though, I think, is going to be implementing or injecting this other sort of unknown in here, which is the political risk that we're starting to see, the geopolitical risk emanating from the Ukraine-Russia backdrop. So we really spent much of the beginning of the year worrying about inflation and the monetary policy backdrop and re-rating of multiples. Now we're adding in another dimension, and that's that geopolitical risk. And what's interesting, and obviously what matters most for the stock market, it's going to be earnings. And what you're looking at here is the trajectory of the S&P 500 earnings over the subsequent quarters. And you really don't see much of a change, right? If you sort of look out, and I always like to look out the farthest there. So look at the top blue line, fourth quarter earnings estimates. They've been slowly and steadily rising. The question then becomes, with this backdrop that we're seeing with geopolitical tensions, are we going to have to start to see some of those estimates starting to come down? And more importantly, if we push out those estimates to 2023, are we going to start to see them start to revise lower as well? The bottom line, though, is given the uncertainty that we've seen with regard to the Fed and potential interest rate policies, earning expectations have actually held up fairly well. For right or for wrong, that's something I found very interesting. But then it shifts us sort of this next issue that's popped up, and that actually may accelerate some of those earnings revisions. And that's what's going on the geopolitical front. And obviously the issue, we've had some supply chain issues that are really pushing on that inflation backdrop that George was alluding to. I'm going to look at it a little bit differently in terms of looking at the U.S. relative to Europe in this case, because I think this is where a lot of portfolio implementations, I think, can really start to manifest. And all we're simply looking at here is the contribution to inflation on the European side. And it's a little bit different than what we're seeing in the United States. The U.S., I think, is much more widespread in terms of the distribution of impacts from inflation. When you look at the composition of inflation in Europe, it's very heavily skewed towards that light blue line, which is basically energy. So that energy component, I think, has an outsized effect when we think about inflation and the impacts relative to the United States. And that has some significant ramifications in terms of how we think about investments going forward in here. And if we think about who's got the capacity to absorb these higher energy costs, or in the broader scheme, who's got the capacity to really absorb higher inflation levels. And again, the longer this conflict plays out, the longer the sanctions stay in effect, the longer the supply chain issues linger, those inflation numbers are going to continue to persist for a lot longer. And that potentially has some significant ramifications on the economic front going forward. But what you're looking at here, this is JP Morgan's growth forecast revision index. And we started them basically at the beginning of 2019, just to show the evolution of growth expectations. You can see the significant drop that we had on the back of COVID. We get the recovery, and then more recently, what's been going on. And you can see fairly consistent. We're starting to see a little bit of softening. Unfortunately, these numbers only go up to the end of February, right before really the hostilities begin to escalate. I actually looked at this right before I jumped on the call. They've all started to roll over, but the big one is really that bottom one. The euro area has really seen a sharp revision lower. And so if we think about that previous slide that I just walked through, looking at the adverse impacts from inflation and that outsized impact from oil and energy prices on the European backdrop, that started to get reflected in a downdraft or downgrading of the potential growth backdrop for the euro area. And it's much more, I think, important and much more impactful on the European economy than what we're seeing on the US side. And that, again, is going to have some, I think, investment implications when we think about it. The thing that I want to point out, though, is who really has the capacity to absorb those higher energy costs. And if we look at the consumption backdrop, and again, George had this slide in a little bit of a different format, but the point being on this one, we're just simply looking at how the U.S. consumers have been on the disposable income side. How have things shifted on that disposable income side? And we're simply rebasing this to trend prior to the COVID backdrop. And you can see how we've got some pretty wavy lines there. The light blue one, that's the U.S. disposable income backdrop. You can see some sharp spikes that occurred in there. And it's not surprising, those match up basically with the stimulus packages that Congress had announced and basically sent out to the U.S. consumer. But you can see on the other side of the equation there, sort of the green line, the darker blue line, and the purple lines, not quite the same response on the fiscal side for a lot of the major European countries. And so those stimulus checks that were sent out, I think made a big difference in terms of supporting that spending backdrop for the US consumer. And you can see we're actually still above trend, and that's one of the charts that I think George had shown us. But when we look at basically the big four in Europe, not quite returning back to trend. And if we think about those consumption levels, right, that disposable income is a big portion of that consuming backdrop. We're seeing, again, that recovery not necessarily getting back up to pre-COVID levels. Now we start to lump in the potential for higher energy costs. Who's set up, I think, to really maybe absorb incremental prices at the pump or at the grocery store? And unfortunately, in this case, it looks like the US has a little bit more capacity to absorb those higher energy costs. So when we think about this going forward, who's got the capacity, who's got the ability to maybe withstand higher energy prices on a more prolonged basis? Well, I think, again, Europe is a little bit more exposed to those higher prices than maybe what we'd see in the United States. And on top of it, when we start to think about the balance sheets in the United States, they're in a much better place. And we hear a lot of talk about stagflation, for example. And one of the things I want to point out with stagflation, just by the pure definitional term, you're going to have rising prices and then basically an economic contraction. I'm not sure we're quite in that camp. You know, certainly we're expecting inflation to remain somewhat elevated for some time, but I think we're more in the camp that growth is going to slow, not yet seeing signs, or at least the roadmap leading us to a potential recession. And a couple of things here to think about and why the US maybe has a little bit of an advantage to the rest of the world with this backdrop. You know, the first one, the US is a net exporter of oil. And basically relative to what we've seen maybe in the 80s, where if oil prices were to increase, that acts as a tax on the consumer, those basic revenues end up exiting and heading to the Middle East. With the US being a net exporter, that just gets recycled within the US economy. So what happens, it's basically a shift in growth where you're taking a little bit of that growth away from the consumer and basically giving it to the energy producer. So just a little bit of a reshuffling of the deck, if you will. And if we think about the household balance sheet, again, we talked a little bit about that disposable income backdrop, but if you look at what happened as a result of those transfer payments that were sent out in the middle of COVID backdrop, a lot of the US consumers basically deleveraged their balance sheet, right? They paid off a lot of their debts, they paid off credit cards, they paid down some of those revolving credits, mortgage payments. The household balance sheet really has never been in better shape. And if we extend that out right now, we're still seeing banks willing to lend, the availability of credits out there, although the price is going to be going up. But in the grand scheme of things, the ability for that household's component to actually absorb some of those higher costs, the balance sheet's in pretty good shape to be able to do this relative to maybe some of the other periods where you hear about that stagflation backdrop. And a couple other things to think about as well. You know, we're starting at a significantly higher level of nominal growth. I think when we think about previous instances of stagflation, those growth levels were much lower. So given where we are today relative to history, we have a little bit more room to maybe give a little bit back. And then we also think about where real rates are right now. Real rates are actually deeply negative. And so from that standpoint, again, the cost of borrowing still remains fairly cheap. If we switch over to the corporate side of the equation, right, the balance sheet for most corporates are still in pretty good shape. And what's interesting, every time we come out of a major drawdown, whether it be the financial crisis or in this case, the COVID crisis, and I don't extend it far enough back, but even the .com, you see one thing, and that's efficiency gains from a lot of these corporates. They learned how to cope through a lot of these stressful times. And as a result, their margins tend to start to expand. So you get much more operating leverage. And that's what you're looking at here, that EBIT margin. And you can see in that light blue line, US sitting up on top in terms of that net profitability or that net margin backdrop. So again, when we think about who's set up to absorb the potential for higher costs going forward, US companies have a little bit of a cushion on that margin side to absorb some of those higher costs. So when we start to think about this from a general backdrop, at least in the near term, until we see potential for a sustained relief in higher commodity prices and higher energy prices, we think maybe the U.S. is a little bit better off in terms of sustaining that. And as a result, you know, we've been favoring more in the U.S. equity front recently relative to the rest of the world. So one potential portfolio ramification, if you will, with regard to investing. And then I'm going to touch real quick on the fixed income side of the portfolio. What you're looking at here, basically the menu of potential asset classes in which you can invest. I'm showing you on the light blue bars, that's the nominal yield. What I've done is simply deflate those nominal yields by basically the five-year forward inflation number. So the market's perception of long-term inflation, if you will. What's interesting, you can see More recently, we're starting to see a little bit of a backup in spreads and yields. Point being, you're not getting a ton of real yields on the fixed income side of the portfolio. That's making that side of your portfolio somewhat of a struggle. And if you sort of think about where the actual real yields are, you're tending to lean farther out in that risk spectrum. So the point being, pick up that incremental yield, if you will, you're having to take incrementally more risk on. And in this case, in some cases, you're taking incrementally more leverage on. So the point being, we're hearing a lot from our clients to struggle with what do you do with the fixed income side of your portfolio. We remind everybody, listen, you can't forget about bonds, right? Bonds serve a purpose. They are still an equity risk offset. They're still a funding source for drawdowns. You can move money into the equity market when the markets sell off. But while we may still be scratching our heads and saying, where do we see value in fixed income? We just can't forget about what it's there for, and that's the equity risk offset as well as a funding source. So that's one thing I wanted to highlight. And the second one that makes this a little bit more challenging and why equities might still have some support in here, it's simply equities don't look all that expensive when you think about it in relative terms. And so we always talk about price to earnings ratios. That's pretty common for the equity side of the equation. Let's flip that and let's make a PE ratio for the bond side of the equation. So all we're simply doing, we're going to invert that yield to maturity. And you can see as we sort of move from left to right, expensive to cheap. And right in the middle there, you can see the S&P 500 trading at 19 times. Well, the equivalent PE ratio for treasuries and then really the higher quality of the marketplace, multiples above what we're seeing on the equity space. So from a relative value perspective, it's very difficult to have a lot of allocation towards that fixed income portion, simply because on a real adjusted basis, they're not throwing off much yield. So from that standpoint, that's traditional 60-40. You might have to take a little bit more risk on the equity side, but knowing that you are upping the risk in the portfolio and being very cognizant of that backdrop. So thinking about those risk return profiles, something to think about in terms of positioning going forward. So I'll stop there, and I guess I'll throw it back over, and happy to have some engaging Q&A on the back of what we've talked about.
Jack, thank you so much. Thank you, and thank you to you too, George. Wow, again, a marathon of data and just good stuff. I think our crowd here is chewing on all of what you've said, both of you, because I'm not seeing many questions. So I'm going to make a call out. No, I think they were sort of deer in a headlight kind of thing, So I think this is a testament to both of you, but. I am going to ask you a question, as there was two questions and that were asked, and they are both related, and they basically ask the both of you, and you can decide who's going to talk first, but about the American consumer, and and you both talked about it, but basically. I got one question saying basically how far can we push the American consumer, with high prices left and right, and another similar question is just basically what's it going to take for consumption to decline, and then of course margins to drop, etc. But so if you can. I don't know if you want to talk also a little bit about rates with that as well, or however you want to talk about. George, maybe you want to start with that. Give Jack a break for a little bit.
Sure, Francois. Happy to take a stab at it. And it's a very important question, and it's a little complicated too, because the U.S. consumer is not just one monolithic entity, right? There's a lot of different segments of the economy, a lot of different types of consumers, honestly. But overall, in the aggregate, the consumer's in pretty good shape. Jack's chart on disposable income, I thought, was a really great way to illustrate that. The spending is coming down just by its own kind of law of gravity, almost kind of taking over to some extent, and things are slowing down. There's still a pretty big shift going on still with a transfer of buying and purchasing goods, refrigerators and cars and cell phones and things like that to services. And so we look at a couple indicators that shows that people are starting to travel again more. People are going to restaurants. Again, kind of that post-pandemic kind of get out and feel good again kind of movement is still happening, and that's still transitioning from a kind of a goods-based recovery to a services-based recovery. And so the overall consumer is feeling pretty good about that, and they're somewhat price insensitive. They're almost willing to pay top dollar to travel a bit more. They're willing to travel. Willing to spend more dollars on some services in general. More recent, the price of oil is going to be noteworthy, and I think that's going to be really impactful on probably the lower income part of the distribution, if you will. And that's where I think there's less discretionary income to begin with. Thankfully, and again, as Jack pointed out really well, there was a lot of stimulus that was put forward before the spike in oil and things of that sort. But I've seen things that suggest that maybe $6 a gallon is kind of the tipping point where you really start to see a big slowdown in demand. I think that it's interesting because on the one hand, if you think about the psyche of the consumer, about 40% of Americans right now, and just speaking about the American perspective, I'm sure Europe has similar expectations too, but 40% of Americans think inflation is too high and they really need to do something. But at the same time, about 40% of Americans think that they'd be willing to pay more to make sure that Russia feels some pain for what they've done. And how that gets reconciled is going to be difficult to see. So I think the short answer is, for now, it seems as if that the consumer is holding on pretty well. Their balance sheets are in aggregate pretty good shape. If nothing else, their stock portfolios, even though they've taken a little bit of debt lately, are still elevated. Home prices are still high in most cases. So for most of the consumer experience, it's pretty good. But there are some headwinds that are starting to rise up a little bit as things slow down, perhaps next year.
Right.
Yeah,
Jack,
I would add on to the back of that, and I think I'm basically going to echo a lot of the same points that George just made. And the big one there is simply that I don't think we can have a blanket comment about the entire consumption backdrop, because the different segments of that really matter, right? I would say the first thing I want to highlight, though, is we've seen savings and saving, right? The savings is basically the accumulated wealth that you've had from a lot of those transfer payments. It's the money that's accumulated in your bank account. And then savings, that's going to be, or saving, the actual change in that, if you will. What we've seen is the savings has started to slow back to trend level, but the level of savings remains very elevated, right? I think we're sitting on north of $2 trillion in accumulated savings. The problem with that number, though, is that it doesn't really fall across the entire income spectrum equally, right? A lot of that is basically accumulated to the higher portions of the wealth bearers. So the top 1% of the wealth earners basically have accrued a lot of that savings. So George's point, when we start to draw down on some of those savings backdrops, that disposable income figure, not quite as robust for the lower income backdrop, and hence they're going to be the ones feeling a little bit more of the pinch when you start talking about prices at the grocery market, prices at the pump, so to speak, and they're the ones that tend to have a greater propensity to consume. So the question becomes, at what point do we start to see some demand destruction and see some of that consumption slow? There's probably still room for it to run, but is it? Do we have a long runway for that? Probably not. The last piece I would point out, and again, George had highlighted this, I think there's a little bit of pent-up COVID demand, if you will, and I know a lot of anecdotal evidence that I'm hearing and seeing. People want to get out and get on vacation. They probably haven't had really a chance to do that during COVID. And the one underlying theme that I continue to hear about is, yeah, we're going to go away on vacation. It stinks that I'm going to have to pay a little bit more for my airfare or for my hotel, but I'm still going to do it because I want to do it. So I think that's the other resonating factor, at least in the near term, that sort of pent-up COVID demand. People are still willing to pay because it's something that, quite frankly, they haven't had the ability to do for quite some time. That I think will help, at least in the interim as well, cushion some of this.
Great points. So we talked about when talking about the consumer and the prices that the American consumer or the European consumer is having to pay, these rising prices. There has been definitely a deflationary effect happening during this inflationary environment, and that's the destruction of capital in the stock market. Obviously, we went back to back 2 very good years in the stock markets, both European and US. The beginning of this year, not so much. As of yesterday, I know today is up quite a bit, but sort of the mid-teens down on the major index, the S&P 500, and then if you look at anything that's technology, it's even worse. So a lot of people own this stuff. Not everybody, I understand that also, but so that's happening. And but how about that other big piece of asset that Americans own, which is real estate? What do you make of the current situation? Obviously, something's going to happen with rates. What can you tell us a little bit about what you think of consumer real estate, mostly right now in the U.S., and maybe even if you have some thoughts on Europe as well, if you can.
Sure. Well, again, just like the American consumer isn't one big thing, as you pointed out, Francois, real estate is not just one big thing either. It's really dependent on geography, as you know, and certainly property type as well. On the consumer side, though, I think the residential market is holding pretty well, and at least here in the parts of the United States, there's a pretty big demographic tailwind that still is apparent, and there's been a lot of pent-up demand. A lot of people have actually, I think, coming out of the great financial crisis of 2008-9, people were very, very slow to re-engage in the housing market. So they were kind of delaying purchases in some cases, and now that maybe that was fashionable in your late 20s, early 30s, but when you get to be 35 or even 40, maybe your parents want you out of their basement by then at least. And you're starting to see this demographic, a bit of a boom almost with respect to housing demand in parts of the country on a residential basis. And so there's a survey that we've looked at that the University of Michigan puts together, and it asks people, do you think now is a good time to buy a house? And surprisingly, that is a record low. And that's not really just geopolitical noise. I mean, there was some of that. This actually, the story I was thinking about actually was through January. So this was really probably before the Ukrainian situation really reared its ugly head. But nonetheless, it suggests that people just found it really miserable to go through the home buying process. And frankly, inventory, the reason they cited that was inventories were so low. And if you juxtapose people's sentiment towards buying a house as being low, demand, on the other hand, is at near all-time highs or close to it, at least a cycle high. That's a really interesting net backdrop. So kind of what Jack was saying with respect to people willing to pay a few more dollars for a hotel room or for airfare, they're kind of doing the same thing with the housing market, where they're willing to pay a little bit more. They're kind of stretching a little bit more, perhaps too, but the demand is still there. So I do think at some point rates will start to matter a little bit. Again, maybe some of the geopolitical noise might kind of dent some of the enthusiasm, but the demographic backdrop is still pretty favorable for housing overall.
And I would add a couple things there. That demographic backdrop is pretty significant. I'll get to that in a second, because I think there's a couple things that are worth pointing out there. But what matters most in terms of home buying, it's not necessarily the housing price, it's how much is that monthly payment going to cost you as a percentage of your income, right? And so what's been going on is, even though we might see a marginal increase in those mortgage rates because rates are pushing higher, wages have actually gone up at a faster pace. So that mortgage payment as a percentage of your overall wage income still remains fairly low. And that's, I think, one thing that's going to continue to be supportive going forward here. We start to think about that. The housing supply, the number of houses that are on the market right now is still at all-time lows. And that goes back to the supply and demand backdrop that we were just talking about with regard to the demographic boom, that millennial bulge. The typical homeowners are basically going to be right around, or household formation begins at right around 32, 33 years old. And if you look at where the peak in the millennials are right now, they're at about 28. So you still have another 3 or 4 years before the peak in the millennial generation gets to that peak household formation backdrop. So it's going to be very challenging, I think, to really see a market pullback in terms of the real estate market because of that demographic backdrop. And I would take that one step further. Think about that wealth transfer, right? Those people, the millennials, are becoming moving into that sweet spot with regards to their household formation, but that also means they're moving into that sweet spot in wealth creation. So they're starting to get peak money earning potential at that point, on top of some of the boomers now transferring their retirement income back to some of their generations there. That's going to change the risk profile from those investors, right? all of a sudden you've got probably conservative portfolios from boomers being passed along to millennials. The millennials are going to be much more risk-seeking, much more into digital assets, Bitcoin, NFTs, high-flying techs. All of a sudden, that wealth is going to be reallocated back into not only the real estate market, it's going to find its way back to the stock market as well. So again, when you look in history, when you get these cycles in these run times with the equity market, they match up very well with these boom and bust cycles on the demographic side. And we're just starting to get into that peak millennial bulge, if you will. And that's something I think when you think longer term from an investment perspective, it's a key, I think, ingredient in terms of why we probably think things continue to run in here.
Okay, well, that's great to hear those some optimism here on both those fronts. As a matter of fact, I'm going to take a few of the questions that were asked and try to package them all in once. Jack, of course, you come first to mind in terms of answering, but I think George also will have some very good things to say. And basically, we're talking now. The question will be more on opportunities and dangers right here, right now. You know, a lot has happened so fast. Okay, people's portfolios, whether you had seen this coming a little bit or not, things have happened. Do you have a lot of cash? Do you not, etc.? I don't know. Everybody's situation is very much different. So, George, I remember in your presentation that you thought that it was your view that this year's market would probably not amount to much in terms of return. Yet the markets are already down quite a bit. So obviously, I would think that they would rise from here till the end of the year. And so having a more optimistic view of markets. That is also my view, even though I tend to have a more contrarian view and not always very optimistic. But I personally feel that the economy is evolving and the economic cycle is evolving into a mid-cycle, and that the leadership won't be the same necessarily as where it was before, and so I don't want to necessarily say what I'm doing, but I'm really more interested in what your thoughts are, more in terms of, or what some of the things that we're seeing right now, are they going to be continuing? I'm thinking about what we're seeing in the energy and the commodities, maybe the precious metals too, or is it the time to go into technology again? I mean, there's so much to do on a tactical basis, but also mistakes to make, and it's very hard right now. Do you have? I know, and you said quite a bit already, so I'm going to hand it off to you.
Yeah,
who wants to take it first? Yeah.
I'll take a stab at it, and I'm sure Jack has a few things to say. I mean, sometimes in these moments, the advice is just to do very little or do nothing and just sit there, which is kind of hard to process then, because we're so ingrained to want to take action at times, especially when the chatter from the media is so intense. I think if you can stomach some volatility, and I do think things are going to be choppy for a while. I mean, I think this situation in Ukraine is a very serious situation, and no one really knows how this will play out. No one. I mean, maybe Putin does, but maybe even his calculus has changed a lot in the last 2 weeks, perhaps. So it's really hard to say. I mean, I think if things become really severe, if there's maybe an incursion in a NATO country, that's a really big tail risk event that we have to be prepared for, perhaps. And then maybe the commodity price you talked about really look significantly dire, right, in terms of they have a further spike on the upside. I tend to be more of a half full kind of person, though, and think that we'll find a way out of this somehow. Some of the geopolitical analysts aren't as optimistic, perhaps, but I'm hopeful that optimism will prevail once again. So what we've tried to suggest is that, yes, you want to think about your entry points, and sometimes it is important to kind of go against the grain a little bit and maybe selectively put capital to work. we're not too big on making any big bets at the moment. Your point about technology, yes or no, we've been slightly kind of I guess de-emphasizing some of the really high valued companies for about a year now, and that's kind of hurt us a little bit last year, but it's helping us this year to some extent. So we've avoided some of the real speculative companies and speculative stocks. We tend to really like some high quality companies, high quality issuers, companies that have really strong balance sheets, maybe competitive positions that are really defensible, led by strong management teams. You know, those things are pretty much always in vogue, but they really are probably more important these days than ever.
Sure.
And to your point about the cycle, I tend to agree with you, Francois, that this is kind of more of a mid-cycle. We're definitely not early cycle in terms of, we kind of been through the recovery phase of the past pandemic reopening, if you will, but there's a bit of room to go. There are little signs that are flashing that might be late cycle, just in terms of things slowing down. We talked about this yield curve indicator that people look at, and it's getting a little bit, it's flashing yellow, but not flashing red. So again, maybe not sticking your neck out. And so if you have excess capital to invest, my suggestion is to kind of buy a little bit, wait, and if, again, volatility comes back again. Today's actually, you know, I think the risk off is a pretty strong, there's a pretty strong market rally happening today, I think. Maybe stay away, but then again, if you have capital put to work, it might go down lower. I'm not trying to time the market, but just be selective. And I think if nothing else, you know, really kind of, it's a good time to kind of see how much risk you have in your portfolio. I mean, if nothing else, what's happened the last few weeks or so has given us a kind of a teaching moment to say, well, if I can't withstand this kind of volatility, maybe I should do something different. But on the other hand, if I didn't do nothing with my portfolio, then okay, maybe my life hasn't changed too much. Fortunately, maybe others have really been displaced by this and I need to help them. But in terms of my situation, if my situation has changed too much financially, then let's try and find a way to just hunker down, strap in the seatbelt, and try to ride this out.
Right. Thank you. Thank you. Wise words. Jack.
Yeah, I would say a couple of things. You know, we expected chop for much of the first half. You know, I think there's a lot of uncertainty with regard to monetary policy. And typically when you have those beginning, when you go back in history and look at the beginning of a tightening cycle, the market has a period of indigestion. It's almost textbook that happens. Throw in the idea of now you've got a war occurring in Europe, just another sort of piece of the puzzle for increased volatility. So we were sort of expecting, remember, we were calling a W-shaped market, if you will, probably through much of the first half. And as you got to the second half, we were going to start to see much more clarity on a lot of these bigger issues, right? You're going to probably get a better understanding that COVID is now an endemic. Supply chains are starting to clean up. You're starting to see the labor market settle down. You're going to have a better idea of inflation and where the Fed is going. And that would probably give us a little bit of a recipe to you know, get a little bit more comfortable with the backdrop and basically have a better second half of the year as opposed to the first half. That's probably still our base case scenario. But I think we're starting obviously from a much lower standpoint there. But the bottom line for us, you know, from a short-term tactical perspective, we look at a lot of sentiment indicators. And what's interesting, when we see the sentiment indicators and we look at them across both the retail and the institutional market, those sentiment indicators that we're following are at levels that we saw in the heart of the COVID crisis back in March of 2020. I would say that we're probably in a little bit of a better situation today, even with those headwinds that we're talking about relative to March of 2020, when we have no idea how COVID was going to play out. So just some point of comparison there. The market has gone through a significant bearish tilt here, and obviously that tends to act as a pretty good contrarian trade. So when you think about what's discounted at current levels, you're looking at 7 rate hikes priced in from the Fed already. You're looking at sentiment that's been basically cratered. We've seen redemptions kicking in. That sets up for basically saying, you know, the market's priced in quite a bit of downside risk. Think about it on the oil front, right? Oil hit 131 on WTI overnight there a couple of days ago when the talk of sanctions were really starting to kick in. What's happened since? Oil's actually come off a bit. So the point being, a lot of that political premium is built in a lot of these places that we're looking. And that's what matters from the market's perspective, what's already discounted. And I think at this point, there is still a lot of bad news discounted. Can we have more? Obviously, but we're getting close to, I think, a point where maybe that skew is tilted a little bit more to the bearish side. And maybe we get some upside surprises in here, and that puts a little bit of a bid to the market. Still choppy, but I think, you know, earnings are what matter. And right now, I don't see any sort of movement in earnings or expect earnings to get to a point where have to start thinking about a recession. We still have a low probability of that. And so that gives us, I think, a reason to be optimistic between now and the end of the year.
Wow, great. George, I know we're approaching the end of our hour. Do you either of you want to say one last word before we close this out? I think we did it pretty much, right? I mean,
yeah, we covered a lot of ground. Yeah, you did a great job of keeping us on track, Francois. So I think we've kind of said a lot in a really jam-packed hour. But again, thank you for the opportunity. It's been great to have this conversation with you and Jack. It's been a pleasure. Louise, thanks for having us as well.
yeah.
Oh, thank you both for joining, this speaker event, and Francois for moderating this. And thank you to everyone who joined the call to listen to this. And hopefully you found some informative stuff here.
Thank you, everyone, and good luck at digesting all the information.
All right, stay well. Thank you.
Thank you.
Thanks.
Bye,
A lot of
George.
fun.
Thank you again.
Good luck. Take care.
Thank you.